What is the balance sheet? How does the Fed shrink it? Why do they shrink it? And how does that affect our economy? Hi, this is Ivory Hecker with Noble Gold Investments. What is the Fed balance sheet? Any debt you own, student loans, credit cards, a mortgage, is a liability. The things you own, stocks, bonds, or a house, for example, are considered assets. If you record it on paper, that is a balance sheet. The same goes for the Fed. U.S. paper currency, as well as money that commercial banks hold in accounts at the Fed, are counted as a liability. Treasuries and other securities, on the other hand, are considered assets. The Fed has a record of everything it owes and owns. How does the Fed's balance sheet impact the economy? The Fed uses its balance sheet to influence longer-term interest rates. When it wants to stimulate the economy, it buys more assets and expands its asset portfolio. That puts more money out there for people to spend. When the Fed wants to restrict growth, it lets assets roll off and shrink the balance sheet. Securities mature and are not replaced. That shrinks the amount of money in the economy. When the balance sheet balloons, the interest rates go down. When the Fed shrinks the balance sheet, interest rates go up. Now that we know the basics, let's get to the important question. Why would the Fed balloon or shrink the balance sheet? When COVID-19 hit, the entire country shut down. No one was working except frontliners. That practically shut down the economy. To avoid crashing, the U.S. government gave people money. The Fed printed money out of thin air and sent it to people. The problem is that we weren't producing anything. People weren't going to work. Factories and manufacturers were shut down. As in basic economics, if there is an abundance of money but nothing to buy, the prices of goods go up. That results in inflation. If we don't remedy that, the US dollar will lose its value. We don't want that. There are two ways to prevent that from happening. First, increase our GDP. We need to produce more goods. Naturally, we are limited by the capacity of machines and natural speed at which goods are produced and the people willing to go to work to produce those things. We have a shortage of all that. The only other option is to tighten the money supply. This is achieved by quantitative tightening, and shrinking the balance sheet is part of that. With less money circulating, the price of goods will go down. Of course, that also means more people have the capacity to spend money, but that's another video. How does the Fed shrink its balance sheet? It doesn't reinvest the funds it receives from maturing securities. When a Treasury security hits its maturity date, the Fed will not reinvest the proceeds into another Treasury security. Instead, it will redeem the maturing security. But what does this mean for you? Less money going around means there's less money for people to spend. That might cause businesses to delay any new investments, including hiring. The worst case scenario is more companies closing down and more people losing their jobs. Another group caught in the crossfire could be investors like you and me. Everything the Fed has been doing has been shaking the financial conditions. With the S&P 500 down more than 19% the start of the year, the cryptocurrency market is still down relative to 2021. More companies are laying off workers. So keep a long-term focus and tune out the noise. Invest, invest, invest.